So, got to show you this disclaimer. So, I run a investment fund, and I'm a finance guy. So I run an investment fund in Austin. We have publicly traded companies. We're going to be talking about some of those companies. Just kind of have to show you that real quick. So what I want to talk to you today is I want to talk to you about a framework that the best of the best leaders that we invest in use to create the most value at their businesses. And we call those leaders the Mount Rushmore leaders. And we define them as the most innovative leaders of our time who are building these growing businesses that customers love. So customers always have very positive feelings whenever you mention the name of the company. And the most important part is where the most talented people want to work. So for example, the one in the fedora, and he always wears a fedora, is Toby Lutke, the founder of Shopify. And Toby is based in Ottawa, and Ottawa has below freezing temperature, and he's able to take a lot of tech talent out of California, sunny California, to go and work in this sub-zero climate to work for his company because they believe so much in his purpose and the work that he's doing. So before I start, I kind of want to give you a little background on how we got to investing them, but these are some of the things I'm going to be talking about, the best practices. So they're always creating an attractive business model. So they're always trying to figure out, how do I make my business model better? They're always emphasizing that in all of their decisions. Second thing is they're always making decisions for the future, not for the current state. And that sounds like long-term thinking, but there's a little bit more nuance to that. The third thing is they're always focused on solving customer problems. This is the most important thing, and not focused on selling. And so I'll kind of go into the differences of those two things. And then they're always fighting against centralization, bureaucracy, and trying to get decentralized business models. So those are the best practices. So the way I arrived at this is back in high school, about 92 or something like that, I read this book, and I immediately fell in love with the investment philosophy as taught by Warren Buffett. I started attending the shareholder meetings after reading this book. I started reading every letter. I wrote lots of the CEOs that run the Berkshire subsidiaries and met with them to learn more about Buffett. And even started drinking like cherry Cokes, like 10 a day because gained weight and stupid thing I did. So the one thing you learn from Warren Buffett is that he's always talking about investing in a company that has an established competitive advantage. So picture a castle, with a moat around it, and the competitors can't break into it. And so for my first decade of investing, I actually just invested in companies that had competitive advantages. That's what I specialized in. But after 10 years, I had terrible results. I was actually underperforming the S&P. I was in the fund industry, didn't want to admit it to all my other friends, but I tried to figure out, where did I screw up? Where did I go wrong? And what I learned is that most value in a business is created as a leader is building the competitive advantage, not after it already has one. So if you look at Microsoft stock, from 1975, when it went public and as Gates built that competitive advantage, that's when all the value was created. Up to that $50 or $60 a share. But in the last 19 years, the stock is up only 2.5 times. So I was investing in the companies that were on this right side that already had this established. So that's why I started studying all these leaders on how do you build a competitive advantage? How do I identify them? What are the patterns that I need to look for so I can predict when somebody is building a competitive advantage? And so that's what led me to those best practices. So we'll start with the first one. And that's create an attractive business model. So if you've lived in the 80s, you obviously know who this is. Fabio is not dead. I'm going to keep him alive. So the business model you have, all of you in this room, whatever you have, it determines how quickly you can grow value. So if you have a software business, you're going to grow value at a lot quicker rate than if you have an oil and gas company. Because in the oil and gas company, you're constantly throwing capital back into the ground. So the rate of the value creation is all due to your business model. So what does an ideal business model look like? Well, it's got these characteristics. This is the ideal business that we all look for. Recurring revenues, generates tons of free cash flow, very important component, able to reinvest that free cash flow back at rates of return greater than 20%, creating a compound machine. Low CapEx requirements. The ability to scale and operating leverage, so your fixed costs go down as your revenues go up. High margins, high gross margins, high free cash flow margins, and then pricing power, just that you're not in a position where you're having to constantly discount your items. And so what the Mount Rushmore leaders are always doing is trying to get their business to this ideal. So I'm going to give you two examples of two companies you're all familiar with. Well, actually, one you're not familiar with, but one you are, that were able to do that. So the first example is Marriott. We're all familiar with Marriott. But back in the 80s, Marriott used to own all of its hotel properties. And so it had, and it started developing this management company. So it started taking over certain properties of other people, and they started developing this management company. The management company looked a lot like that ideal business model. In fact, it had all those characteristics. But the problem was that they had all this hotel ownership, which was high CapEx requirements. So they were constantly reinvesting all the money from that management side into the property. And so in the 80s, they decided to just spin off all of the property assets into a separate entity called Host Marriott. And it was a REIT, a publicly traded REIT. And by doing that, Marriott shifted itself from having very high CapEx to very low CapEx requirements. And it's something to think as business owners, how can I be getting rid of these assets? How can I get out of, like, say, the real estate business? And had they not done this back then, Marriott would not be the biggest hotel company today. That one decision back then is what allowed them to be the biggest hotel company today. Second example I'm going to talk about is a company that went from having low margins and actually keeping low margins, but was able to turn those into high free cash flow margins. So still charging the same amount for its items, but generating high free cash flow items. But before I talk about that, I kind of want to talk about high margins. So when I think of high margins, I think of a company like Tiffany. So the advantage of high margins is like they have a diamond engagement ring. It takes anywhere from 180 to 250 days to sell a diamond engagement ring in the case. And that's fine. So they're able to cover their rent, they're able to cover their labor expenses, so time doesn't really bother them. So the rule here to remember is that the higher your margins, the slower you have to sell items. But the lower your margins, the faster you have to. Because if Tiffany had a 10%, say, gross profit margin on that diamond engagement ring, and it was taking 180 days to sell it, they would be out of business. So just kind of remember that relationship. So I'm going to talk about a regional grocery store that was able to take low net profit margin of 1.4% and turn it into a free cash flow margin of 10%, following this very simple equation. Just doing two things, but it's never that simple. But they increase product turnover, and what that means just simply is the items in the store that they have on the shelf, they sold them more quickly. Second thing is they maintain low distribution costs. So what had happened is about 15 years ago, this company was in a very small region in the state, and they were thinking of expanding. So the obvious answer was, let's expand into the next city. But somebody very intelligently pointed out that one of the advantages they had by being regional was that they had low distribution costs. And that allowed them to compete with Walmart at that time. They can keep similar, on some items they can keep the same price because of their low distribution costs. So if they started expanding out, they would lose that advantage. But when they looked at their market share numbers for grocery markets in the neighborhoods, it was like 70%. But somebody very intelligently pointed out that that number must have been wrong, that his plan was to customize every store to its neighborhood. So at that point, they were a little bit cookie cutter, they had some customization, but they went on this plan to customize literally every single store for whatever sold in that neighborhood. You were in an affluent neighborhood, they would carry items that sold well in that neighborhood, and so on. And so, for example, they would go shelf by shelf, and they'd say, well, this sells every 10 days, this sells every 20, this every 30, and they would be like, let's experiment with the stuff on the shelf that takes 30 days. And slowly, they started figuring out what that neighborhood wanted. One funny example was crustless bread in 3 neighborhoods, like sold at 10 times the rate as crusted bread. Made no sense. I don't even know how they found that. Like, you don't buy a loaf of crustless bread, but that's how good they got at this with their information. So that's a simple equation to follow. Second thing is that Mount Rushmore leaders are always making decisions for the future, not today's. This is not long-term thinking. Let me give you an example. So today, we're in an economic boom. Corporate profits are at an all-time high. Interest rates are low. Unemployment, many of you in this room are having difficulty finding people. It's a boom. And it's just this crazy boom. Mount Rushmore leaders are actually managing their businesses today as if we were in a recession. So all their decisions they're making today are as if we've already arrived to the recession. They're increasing cash on their balance sheet. They're not expanding. They're not taking any acquisition opportunities right now. They're hiring at a slower rate than their competitors. And the reason is Mount Rushmore leaders know that most value in a business is created during the recessions, not during the booms. Because what happens is when the recession comes, they're able to buy assets at a very cheap price. They're able to get the choice of talented employees. And everyone else who was managing their business in a boom environment is dealing with layoffs. How do we get liquidity? We got to sell some assets. So the Mount Rushmore leader during these times is offensive, and everyone else is defensive. And it's like 99.9% of the people will be defensive when the recession comes. And it's coming. I mean, it's not that too far away. Nobody knows the timing, but it's good to prepare for that. The third thing, and this is the most important, is the Mount Rushmore leaders always focus on solving problems. And what's that mean? It means reducing the pain for the customer, right? That's that's why a lot of you are in business. You've solved a problem for a customer. You're reducing pain. You're easy to do business with. So you're almost like a doctor, just taking away their pain. That's a good example to think about it. Selling is where most companies are. And what selling is, this is when you try to convince, the word is convince, your customers to buy your product or service. So companies that focus on selling have to have large sales forces, they have to have large advertising budgets, but people that are focused on problem solving have no advertising. It's all word of mouth. So all of our holdings, our Mount Rushmore, all of them grew through word of mouth, no advertising. And it's crazy to think Shopify is $1 billion now in sales, going to $1.5 billion this year with no advertising, all word of mouth. And so to further illustrate this is just kind of a simple life cycle of a business. So you start with innovation. You start as a founder. You see the world the way it could be and should be, and so you create a solution. And that's kind of innovation. Innovation is basically problem solving. So at this phase, this is when most value is being created on this side of the life cycle. Most companies fall into this standardization, what I call extract value. Apple, I use Apple here as an example. Since Steve Jobs died, there hasn't really been a lot of innovation at Apple. Larger screen size, longer battery, those innovations have come from their suppliers, not from Apple. But they're extracting value from what they already have. They're not trying to come up with new solutions to solve customer problems. They're thinking, how do we sell more to our customers? And so the thing is, as you're moving down this life cycle, you're getting closer to death, right? And what happens is most companies get into the second phase because that's when professional management takes over, and they have a different mindset. For example, in the pharma industry in the 80s, it was all run by scientists. The CEOs were scientists. The drugs they came up with in those years were actually helpful for people. And then as the deal makers came in as the CEOs, they started standardizing. That's when you started seeing the large sales forces that were pushing drugs on doctors and things like that. So that's the second. The third is commoditization. So my dad passed away 6 years ago, and I inherited an oil and gas company. I'm in a commodity situation. You do not want to go here, people. This is a horrible place to be. You start grinning when you hear that we may go to war with Iran. It's like you get your oil price up. And so you do not want to be in this place. You're just surviving, and you start becoming an evil person. So stay away from commoditization. You don't want to be there. So the fourth thing that I see Mount Rushmore leaders do is that they're always focused on decentralization because they know that creates value. What that means is that the decision-making is made by the employee closest to the customer. So they're always focused on having this kind of structure. Centralization is customer be damned. This is the way we do things here. So a lot of us deal with these types of companies, right? Airline companies, cable companies. I try to get rid of your cable provider. I mean, you got to go through this insane system and procedure, to go through it. And so that centralization destroys value. And the simple reason is because it creates what is a bureaucracy. And what does a bureaucracy look like? It looks like this. This is a bureaucracy. You have one individual working here that's productive, and 10 people supervising that individual. these 10 people are not being productive, but they're overseeing this one person. But this is literally what a bureaucracy looks like. And it is very easy for companies to fall into this trap of getting into a bureaucracy because as they grow, they start thinking, well, I need more systems and procedures and things to kind of monitor the behavior. And so over time, it starts building up over and over. So I'm going to talk about an example of a CEO who I thought was most likely to fail running a company. In fact, I had 100% conviction this guy was going to fail. And this is Mark Hoplamazian, the CEO of Hyatt. So when I read that Mark was going to take over as CEO of Hyatt, I looked at his bio. And basically his bio was that he'd run the Pritzker family office that had 20 individuals in it, and he had no hotel experience. So now he's going to go take over a corporation that has 40, at that time I think it had 42,000 employees. So no hotel experience, finance guy like me, I was like 100% guaranteed failure rate. Where Mark surprised me is when he arrived at Hyatt, he actually admitted to all the employees exactly what I just said. I'm a finance guy, I don't have any hotel experience, but I'm here to learn from you. You know, what's wrong with Hyatt? How could we make this a really cool company? And so he started just visiting from hotel. He spent about a year and a half. He wasn't really talking to analysts during this time, but he's spending about a year and a half interviewing all of the employees of the company and just figuring out, what don't you like about working here? And what he learned is that this incredible bureaucracy had been built up at Hyatt, where their policies and procedures were this thick, and you had people going back to this picture, you had all these people overseeing that one person in the front desk. So there were things like, if you wanted to change rooms, you had to get supervisor approval. So if it was the middle of the night, and somebody wanted to change a room, a guest, come down. I mean, this really, I don't know how many of you stayed at Hyatt during those times, but you basically, if the manager wasn't there or on duty, you weren't gonna get a room change. It was like, I'm sorry, I have to follow this, if not, I'm gonna get written up. And so this whole company had become a company, Hyatt, of just writing employees up. And so Mark just started getting rid of all these things. So he started basically firing all these middle managers that were overseeing this. There were rules such as you can only wear your hair this way in this style. He just said, well, let's just get rid of it. And what had happened is one employee showed up with green hair at the front desk, and somebody said, well, I don't think that's a good image for us. So they said, well, you can't tell them to change it, but if we have a policy that says they can't have green hair, you can tell them to change the hair. And that's how this bureaucracy had been built up. And so Mark just started getting rid of all these things. And in that process, he turned around this very large company. The stock's up 3.5 times. He's created a bunch of profit by focusing on the employees and decentralizing the business. And he continues to do that to this day. So I'd like to end just with some questions to ask yourself. Very simple questions. First one is, how can you make your business model look more like that ideal? So if you don't have pricing power, think creatively, how can I get in a position of pricing power? How can I lower my CapEx requirements? Is there a way to think about my return on capital and getting it up higher and creatively? Second thing is, are you honestly preparing for a recession? I mean, if you're feeling like, oh, I can't hire enough people and I'm borrowing all this money because it's cheap debt and I'm going to be expanding and it's only going to cost me this much, then that means that you're probably going to be running into trouble when the next downturn does come. And then it's not good to be, most of you in this room have probably been through the recession, and it's just a horrible place to be in. Third thing is, are you really focused on solving customer problems, or are you selling? What happens is that in the pursuit of sales growth, you want, a lot of times you get into selling. I see Amazon doing this today. So Amazon went from what I believe was solving customer problems to it's slowly moving into the selling. And I'll give you an example. So when we buy products on Amazon, when we put in the item, it would give us the item that sold the most. This was like 3 years ago. So the item that was selling the most was the top result. And that tended to be the best product, because if lots of people were buying it, it was something that was popular. But now that they've seeking higher sales growth, Amazon has all these ads now, right? Like ad-sponsored listings. You look something up on Amazon, and there's something like 10, interspersed ad-sponsored listings of products that are not really good for you. Some of them, it's just somebody was willing to pay a lot of money to put them there. So they're relying on advertising, not the best products. So they're kind of moving down that life cycle, and that's something to constantly be avoiding. And then, of course, last, are you just making sure the headquarters is serving the field and not the other way around, and constantly thinking about that. Chick-fil-A CEO Dan Cathy always says to me that that's what he does. He says, my job is to just and he says, I gotta constantly fight it, that I gotta remind everybody, we're here to serve the field, not the other way around. But it's very easy to start reversing that trend. So with that, thank you very much for listening, and I hope to see some of you at lunch. All right.